So you're not losing money, but you're not making as much, right? And you have to keep up with your competitors. Now, imagine applying 20 times leverage that, and you can see how the trade goes from wildly profitable to quickly bad all of a sudden. Crowded trade plus deleveraging equals panic.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, everyone. I'm Vince Lanci, and in today's market rundown, we're going to discuss the yen carry trade. Now, some of you may be bored with it already, and some of you may not have a clue what it's about, or have tried to get a clue, and the explanations have been not to your liking, to one way or another. We're going to try and touch on all the bases in 10 minutes and give you a good working understanding, whether you're an MBA student or a layperson who's just trying to navigate the lexicon that they throw at you. You're looking at on the screen right now one manifestation of the yen carry trade and the yen carry trade unwind. But before we do that, let's talk about the markets. The dollar is up 22, backing off the highs. 10-year olds are up 3 at 393. The S&P 500 is up 72 handles. Well, I guess there's no need for an ease if the market keeps expecting there to be an ease. The VIX is down 4.5, up 23 at 23.11. Gold is up $11 at 2,400. Home on the range. Silver is 27.12, up 13. Copper is 398, down almost 3 cents. Oil is up $1.80 at 75.34. Natural gas is 204, hovering around $2. And crypto is strong again, by no means on the highs, but 56,931. That's up 1.6% for Bitcoin, and Ethereum is 24.75, up less than 3/4%. Platinum, palladium are up. Palladium playing a little catch up today, 894, 925. That's platinum and palladium, up 27 for palladium, up 14 for platinum. And grains are mixed. Corn and wheat are on either side of unchanged. Corn's down a couple cents and wheat's up a couple cents, but soybean is weak on its own merits, 1044 down 11 cents. That may be weather related. I'm not sure. Okay, so let's get started. The yen carry trade. Okay, here's the homepage. Great behind the scenes conversation with Tom Luongo that he was smart enough to record. And after retaining attorneys, we've both decided to release it to paying subscribers. There's the HeartNet post. You're familiar with that. There's the Panic Begins. We put out several posts yesterday. Goldman on the 7 things from 2 days ago, and Bloomberg macro, as well as some commentary by us on the VIX stocks. But let's get to the yen. We have this in the post, but we're going to work with slides. A little ambitious today. First thing is the yen carry trade. What is carry? Carry literally means cost of carry. Okay, storage, insurance, the things that it costs you to carry a position, right? So the reason it's called carry with regards to this position is because you're talking about cost of putting on a trade. You're not talking about potential profits from movement in the markets, right? So you're basically talking about carry is, in this case, financial carry. So it's how much do you borrow at is your carry, and how much you lend at is the other side of the carry. So borrowing at a higher rate than you lend, that's negative carry. So a person who borrows at 5% and lends at 2% has negative carry. He assumes the position will stay where it is, and he loses 3%. A person who borrows at 2% and lends at 5%, that's positive carry, right? If you're a commodity person, contango is negative carry. Backwardation is positive carry. So that's what carry literally means, right? What carry assumes is, for the calculation, is no change in asset prices. It's not the reason you put the trade on. Keep that in mind. Next question that many are asking, not that question, that question. Why does it exist? It exists because of economic arbitrage. One country's policies are different than another's, and the goods and services cannot leave those countries as easily as they can leave another country, yet the currency flows freely between borders. Much of economic arbitrage is geopolitical. So in times of geopolitical stability, these carry trades are very stable. Why is it done in currencies? Well, I gave an insight into that. The reason it's called a carry trade in currencies, and this is the funny part of it, is because carry trades assume stability. And the reason it's done in currencies because currencies are managed by nations, and nations are assumed to be stable. And so if you have a stable nation, you don't have day-to-day changes in policy. You don't have all those things. So that's why it's done in currencies. That's why it's labeled as such in currencies and has been for a long time. I have done these trades both profitably and unprofitably. The memorable one that made me a lot of money, and then I gave a lot back, was an Australian US carry trade where I sold US bonds and bought Australian bonds, betting that the currency relationship would remain stable between them. That's another conversation. That's why it's done in currencies. Now, it's also heavily leveraged. Why is it heavily leveraged? Because the traders think that the nation states have perceived stability of currency. And they're right to think that government policies in general move slowly and trend for long periods. So when the Fed wants to raise rates, it's assumed that they'll be raising rates for a while. And so you have an opportunity to put these trades on and hold them for a long period of time. You're borrowing money from one country for possibly years and putting it in usually another country. So that's the carry concept. So because of the perceived safety of it, well, anything that's safe, people leverage. They make it unsafe again. So that's the financial leverage behind that. We'll come back to that in risk in a second. What are the risks? Well, there are two main risks. One risk you can easily understand, and that is everyone does it. If everyone does it, it becomes a crowded trade on exit. So there's a bunch of people waiting for a train. They're all waiting for the same train. They're not all going to fit. Some of them are not going to make it. Some of them are probably going to end up on the tracks as well. Government policies change abruptly. Geopolitics. Now, this one historically has not been a problem, right? Government policies don't change all of a sudden. You could say that the U.S. policy changes every 4 years, potentially, on a presidential election, or maybe every 2 years. But they stay in place for years. You know, these are policies meant to be ongoing, right? Now, in countries not like the U.S., policies also remain for years. Usually, the existence of the government, in an example of a dictatorship, right? In a dictatorship, also stable. How long is the guy alive? You know, of course, there's coup risk, but that's the idea. The idea is government stability, whether it's a shitty government or a good government, is where it's at. Okay. Now, in the, dare I say, mercantile, deglobalized, BRICS, G7, and enmity, is that the word? You now have governments that have to move a lot faster to change policies to mirror their partners or defend against their enemies. And so Japan, which created a huge carry trade for some reason, is now getting out of that huge carry trade for another reason. Side note, remember supply chains have to be repatriated. You know, you have to onshore them and friendshore them and with people you trust. The yen carry trade unwind is a version of a payment chain being repatriated. We need our money back. we need the yen to be strong. We can't rely on someone else's money anymore. Anyway, it's all tied together, sadly. Staying with the risks. Everyone does it. It becomes a crowded trade on exit. Government policies change abruptly. Geopolitics. Okay, there's a nice little picture I threw in there for you. Okay, risk manifested. Why they exit. Well, here's the leverage part. Number one, it's a crowded trade, as I said. And number two, they take a good thing and they leverage it too much. So let's assume, for example, that you have this yen trade on, right? You're borrowing at 0% and you're putting it in something else, in our case, NVIDIA. And when you put it in NVIDIA, you're borrowing at 0% and you're making, I don't know, 50%, let's say, right? But all of a sudden, the government policy changes, right? Now, a small change in interest rates from 0.1% to 0.25%, which is perceived to be happening in Japan, is a borrowing cost increase of 150%. It reduces your edge, okay? So you're not losing money, but you're not making as much, right? And you have to keep up with your competitors. Now, imagine applying 20 times leverage that, and you can see how the trade goes from wildly profitable to quickly bad all of a sudden. Crowded trade plus deleveraging equals panic. That's it. And here's the bonus. You're probably not going to hear this anywhere else, but we're going to give it to you. All right. The hidden problem is Wall Street. It's not so hidden, but I'm going to tell you why it's a hidden problem. All right. When a carry opportunity presents itself in Japan, in Australia, in New Zealand, wherever money is cheap, wherever it's perceived that a currency is going down and interest rates are staying low, macro discretionary hedge funds will borrow money, even if they don't have any place to put it, because they need cheap money to keep up with their competitors. So it's cheap financing that everyone does, and it's job security. So they borrow the money, and then frequently they look for something to spend it on. And along comes the Wall Street salesman, which says the AI, the crypto, the this, the that. And these carry trades are the source of a lot of global froth. Now, looking at the chart there, right? That's NVIDIA in the candle chart, and that's the yen, the dollar yen, in the red line. Okay, now they don't always hook up completely, but the bottom line is, as the ability to borrow in yen costs less money, that means the red line going up, the stock of NVIDIA goes up. As the ability to borrow in yen goes up in interest cost, or more expensive in dollar terms, NVIDIA goes down. Okay, this is what's going on. The AI example is a carry trade determines where you borrow. Japan's the cheapest, I'll borrow money there. The hot story determines where you invest. And that's what happened. Which brings us to the lemmings. The lemmings. All right. The conclusion is carry trades exist because of artificial differences between economies. So economies can't cross borders so easily, but money can, right? Then you have governments, specifically the Fed, turning a blind eye to opportunistic leveraging the difference, to opportunists leveraging the difference. Oh, everyone's borrowing trillions of yen and buying NVIDIA. Well, if it ain't broke, don't fix it. And then they hope it works out. And then when it doesn't work out, which is what is happening now, they put the brakes on it and slow it down and let the market sort it out while picking who they want to save. Now, the yen trade, the yen carry trade, isn't over by any means. It's being unwound in a more orderly fashion. So that's it. I mean, I'll give you some links as well. But the long story short is, carry trades are a source of cheap financing perceived to be stable in geopolitical environments of stability. And they're used to buy something they think is going the other way. That's it. So I'm borrowing money at 0% from the Bank of Japan, and I'm lending money at, simply put, the way I did it, lending money to a country that's giving high rates, right? And I was basically borrowing from the US, right? And lending to Australia. And it worked for a period of time. And it stopped working when commodities turned negative. I remember that very clearly. And that's when I realized that the risk of the currency stability with Australia and the US was about commodity prices. That was years ago. I think the Aussie bond was yielding 9%. It was phenomenal. Anyway, but these guys take it a step further. They go, oh, I'm going to borrow from the Bank of Japan. They don't say money for money. They don't say bonds for bonds. They short Japanese bonds. They take the money and they go, what am I going to put it in? Well, what's the hottest moving thing? And they plow it into that, whether it be NVIDIA, whether it be, a monkey NFT. They just buy whatever's moving. And after it moves, then they tell their client base, this has moved. Here's why it's going to move more. And then Japan says, you know what? Fuck it. We want our money back. We need our money back. Okay. We are going to raise rates. And so they raise rates, and Japanese people bring their money back. The yen strengthens. Investors come back for one reason or another. It's like an earthquake. And when an earthquake happens in a country, the country has to repatriate money to heal itself. And so Japan needs to heal itself. And this is where we are. Staying with the markets here, gold. Let's put gold up here. I'm running late today, aren't I? Let's get rid of the yen. Gold. I think it's got to go to 2360, but I'm not married to that concept. Okay. The open interest in gold, this is important. The open interest in gold has come off substantively. I'll include that chart in the report. Substantively, and gold remains in a range. This market is not a sale by any measure that I look at. I'm Vince. Have a great day.
Thanks for watching this morning's Markets and Metals with Vince Lanci, brought to you each day by Miles Franklin Precious Metals, who we encourage you to contact for your next gold or silver order. And Miles Franklin brings us a gold and silver special each week, where this week's special includes constitutional silver half dollars for only $2.50 over spot, one of the more popular silver items available. And on the gold side, we have 10th ounce American Gold Eagles for only $39 over mil. And to place an order or get your questions answered, call 833-326-4653 or email us at arcadia@milesfranklin.com. And as always, thanks for watching. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.